Good day and warm welcome to Shaped Theory. Today in this video we're looking at fixed assets. Some call it property, plant and equipment, acronymed as PPE. It is important to also mention that we're looking at basic accounting concepts. We're not looking at advanced accounting concepts that you'll find in IS 16, which is the International Accounting Standards. This forms part 1 of the balance sheet item series that Shaped Theory is running. Make sure that you go and check the other videos of these balance sheet items for you to be able to understand all the balance sheet items that you might find in the face of the balance sheet in the annual financial statements. Let's get to work. Let's look at fixed assets. What are fixed assets? How do we define fixed assets? You'll see on the slide that I have, we say that fixed assets are tangible items or assets that the company purchases and use them for production, administration, operation, and distribution of goods and services. So in a nutshell, fixed assets are already assets. They meet the definition of an asset. It says that these are assets that are used for a period that is more than the next 12 months. And these assets are used for either production, administration, operation, or distribution of goods and services. For you to be able to understand what are fixed assets, let's look at examples, and we take those examples and we apply them to the definition above and see if they form part of production, administration, operation, or distribution of goods and services to be sold. And remember, these items or these fixed assets have to be used for a period that is more than the next 12 months. Thus, they are classified as non-current assets. The first example that we're looking at is land. In most cases, when a business purchases land, it will purchase the land to operate in that particular land. So in the definition above, it will form part of operations. Another example is buildings. The same as land, in most cases, a business will buy a building to operate its business in. And on the example above, it's under operation. Again, remember that here the assumption is that you buy the buildings to operate your business in, not buying the building for investment purposes. Another example is machinery. So for you to be able to produce goods, products, in most cases you will buy the machinery, and in buying the machinery, therefore you would be able to start with production. So in the definition above, machinery forms part of production. Same as machinery, we also have equipment, because on the production process or the manufacturing process you need some equipment, and in the definition above, equipment will also form part of production. We therefore have office furniture. In most cases, what we have, in a business, we need to have office furniture. If we have land and buildings, we need to have some furniture that we use to be able to administer our business. In that regard, office furniture on the definition above falls under administration. And then we have vehicles. Because we now produced some goods or we have services that we have to render, we need to transport this or distribute this. And in most cases, we distribute this using vehicles. You would find that the items that I've mentioned on the slide, the 6 items, have something in common. For them to be able to be recognized as fixed assets, they need to be used for a period that is more than the next 12 months. Therefore, that's why in the balance sheet they will be classified as non-current assets. It is also important to note that these are not the only fixed assets item that you'll find on the face of the balance sheet, but these are just common items that you normally find in balance sheets across the industry. So just go and check the others and also define them and see if they meet that definition above there. Now that we looked at defining the fixed assets, let's look at an increase in fixed assets. What is it that leads to an increase in fixed assets? Before we look at an increase in fixed assets, we need to realize that fixed assets are assets. Because they are assets, they will increase on the debit side. And in increasing on the debit side, it means that they have a debit balance. Before we look at some examples on how to account for these fixed assets when they increase, let's look at scenarios that can lead to an increase in fixed assets. The most prominent one is purchase of additional fixed assets. If a company decides to go and purchase an additional fixed asset, there will be an increase in fixed assets, and that fixed asset class would have to be debited. You'll see on the slide, I have revaluation of fixed assets, but this is advanced accounting concepts. We're not going to look at it in this particular video. Do make sure that you check our other videos where we deal with the revaluation of fixed assets. Now let's look at an example. If the company goes and decides to buy an additional fixed asset, that means that would have an increase in fixed assets, and the fixed assets increase on the debit side. In that regard, you'll have to debit your fixed asset. But you need to have a credit entry, because in accounting, what happens on the left-hand side has to happen on the right-hand side also. So the credit entry will depend on how you bought that particular fixed asset. If you bought that particular fixed asset using cash, you'll have to credit the cash in the bank. And the reason for that is because the asset that you have or you had as cash has decreased because you used it to buy another asset. In that regard, that cash in the bank would have to be credited. However, if you used a loan or credit to buy this fixed asset, you'll have to credit loans as liabilities. And you know that liabilities increase on the credit side. That means you have taken an additional liability which in the form of loan, and then that particular liability has to be accounted for on the credit side. Now that we looked at increase in fixed assets, let's look at decrease in fixed assets. What are the factors that can lead to a decrease in fixed assets? Once again, we need to remind ourselves that fixed assets are assets, and when they decrease on the credit side. Before we look at examples of how to account for this decrease in fixed assets, let's look at what are the factors or scenarios that lead to this decrease in fixed assets. The first one that I have on the slide, which is a very prominent one, is disposals of fixed assets. If a company decides that it wants to sell certain fixed assets, then we will have a decrease in fixed assets. The second one that I have on the slide is scrapping of fixed assets or write-off of fixed assets. In this regard, you find that we can't use the certain fixed asset anymore, and the company decides to write it off or to scrap it. In that regard, then we will have a decrease in fixed assets. We also have the third one as impairment. Impairments, you find that you have accounted for a fixed asset at a certain value, but you realize that the actual economic value of this fixed asset is way less than what you've accounted it for. In that regard, you will have to decrease the value of the fixed asset that you accounted for to the actual economic value, and that leads to a decrease in fixed assets, and that process we call it impairment of fixed assets. You see on the slide I have depreciation, but depreciation is not going to form part of this video because we have a separate video that deals with it with depreciation. Because if you look at the items above, the three items above, they directly decrease the fixed asset value in the balance sheet. But with depreciation, it decreased the fixed asset value indirectly, because with depreciation, we credit accumulated depreciation. So we debit our depreciation in the income statement, and in the balance sheet, we credit the accumulated depreciation. In that regard, it's an indirect decrease in our fixed assets value, because we would have a book value which is less than the fixed asset value. And if we don't have any additions next year, in the next following year, the book value will also be less than the book value in the previous year. So in this regard, in this video, we're not looking at depreciation. Do make sure that you check our other video where we explain depreciation in detail. And in that video, we look at the impact of depreciation in fixed assets. Now, let's look at an example. How do we account for decrease in fixed assets? And this example is actually looking at the prominent one, disposals of fixed assets. If the company decides to dispose of fixed assets or sell a fixed asset, it will either sell that particular fixed assets in cash or in credit. If the fixed asset was sold using cash, it means that the cash in the bank will increase because you have additional cash in the bank. And because bank is an asset, it will therefore increase on the debit side because that cash in the bank has increased. The same with debtors. If the company decided to sell that fixed assets using credit, it means that the creditors that you have, or the debtors that you have, actually, to use the correct wording, the debtors that you have increased. And because the debtors are assets, they will therefore increase on the debit side. In that regard, in both instances, you would have to debit an asset. Is either that asset is in the form of bank or is in the form of debtors or receivables. And then because you have sold an asset, and assets decrease on the credit side, you will have to decrease your assets by crediting it on the credit side, where you credited the fixed assets on the slide. So that's it for this video, and thank you for watching. If you like this video, do make sure that you subscribe to our channel. And if you want to read more about accounting related articles, make sure that you visit our website on www.shapedtheory.com. And thank you for watching, and watch the other videos that we have on this series. Thank you very much.